Remember one thing, marginal revenue should be equals to marginal cost. So that important concept would mean that if the cost of offering securities in the market should be able to be at least as much as, rather, the revenue that is to be earned in the securities market should be almost as equal, or should be able to compensate for the cost of entering the market at any given point in time. So that in price to earnings ratio there, where R is required return there, D over P we're saying is the dividend yield there, I is the inflation component, or changes in the purchasing power of goods and services, inflation. Then G is the growth rate, long-term growth rate. Like that. Once we have the growth rate there, we also have changes in supply of the asset. Change in S is change in supply of the asset or security in this case, like that. Then we have finally the change in PE. Change in P stroke E is change in the price to earnings, change in price to earnings ratio. There. That is, in simple terms, the Crona model, where we try and predict or we try and factor in the inflation, the growth rate in the long-term growth rate, the changes in supply of the asset, and also the change in the price to earnings ratio. Remember, we had looked in market-based valuation. We had mentioned the PE as the market price per share divided by the earnings per share. That's how we compute the PE ratio there. Now we move on and look at the Cobb-Douglas economic function. Why these models are useful under equity market equilibrium is because when trying to predict the point where we have the supply of securities or the asset versus the demand, we need to understand these estimates or the estimates of required returns so that we can correctly predict the equilibrium price of the asset or the security there. Now we move on and look at the Cobb-Douglas economic function. The equation is given as follows, where we have y is given as ak, I'll be able to explain all of those inputs over there. Then we have power alpha, then of course this is multiplication there, and then we have the value of L, the labor component, which is given by beta here. Now this y, rather we start with y, is real output there. Then A, we can say that A is the total factor productivity. Total factor productivity there. Then K, we're saying is the capital stock. And then we say that L is the labor output. This alpha represents a constant there. So this is a constant, and also that is a constant. These are constants, and also beta is also constant, like that. So those are constants there that relate. This is a constant. Alpha is a constant that relates to capital stock. Then beta is a constant that relates to labor there. So they should be given something that is very specific. This constant is relates to the capital stock, and the other one relates to the labor productivity. Now, building on this Cobb-Douglas equation, we will assume that that we will be able to now get the change in y, or we put natural logarithms on this, so that we can be able to try and remodel this Cobb-Douglas equation to become something that analysts can be able to use in the financial services industry to try and predict output, the real output there. So he's saying applying natural logs, we have So we apply natural logs and we divide each component. So we have change in y over y there, which is given as change in a over a there. Remember, we're applying natural logs, so this one comes down there. So we'll have plus alpha change in k over k plus, we will be able to now be given this constant over here. Now this constant can be expressed in terms of the alpha there. So we're saying where beta can be equal to 1 minus alpha, like that. So that is a very critical assumption that we need to make in the Cobb-Douglas equation. So we are saying that now bringing this component down, we are saying 1 minus alpha. We've already explained that beta will be 1 minus alpha there. And then we multiply by change in labor over the labor output component there. So this is what we're saying is the remodeled Cobb-Douglas equation there. What we can do is that summary, we can be able to say that the Cobb-Douglas equation is given as change in y is equals to change in a plus alpha change in k over k, rather not over k, change in k plus 1 minus alpha change in L, right there. So that is how we are saying it should be the Cobb-Douglas equation. So we try to look at an example.